Hi, I'm Michael Blackham. I created this spreadsheet. When I first got excited about real estate, I found lots of information and lots of books from supposed gurus on how to be successful in real estate. Unfortunately, most of them didn't give me the tools I needed to actually evaluate an investment property. Some of them had some good ideas, but nothing was really practical. So I spent a lot of time trying to figure out what pieces of information were important and what was the best way to evaluate an investment property. While I was going to school for my MBA, I learned a lot of capital budgeting techniques. And I think that a lot of them apply to real estate. In fact, real estate is a business. So why not treat it like a business? And why not treat it the same way that a company would treat a potential investment opportunity? So I'm going to go through, and I not only want to show you how to use the spreadsheet, but I also want you to understand how the formulas and calculations intertwine and how you can effectively determine whether or not an investment makes sense. Okay, let's get started. The first thing I want to do is just do a quick review. We've got 5 different tabs down here. There's property info, profit and loss, balance sheet, cash flow, and cash flow evaluation. Profit and loss, balance sheet, and cash flow are probably the 3 most important financial statements that we use when evaluating a business. All 3 of them, let me pull one up. Let's go to the profit and loss statement. All 3 of them will calculate out to 15 years. The reason it doesn't go further than that is just because the further you go out into the future, the less certainty you can have when evaluating a piece of property. So 15 years seems like a good spot. If it's on a good trend, it's going to continue, hopefully. But we want to use the 5-year mark, the 10-year mark, and the 15-year mark in this spreadsheet. So let's get back to this first page. And the first thing I want to show you is, let's notice how some of the numbers here are blue and how some are white. The blue ones should be changed and the white should not. Pretty simple, right? So let's use an example. Let's say Joe is an investor and he's looking to buy a new rental property, and he's found a condo that actually looks like it'll work pretty well. It's in a good neighborhood. So let's start with that. The seller's asking $135,000 for it, and you know what? It's pretty reasonable. That's about the market price for it. Joe knows that he will have to come up with about $2,500 in closing costs, and he also knows that his income tax rate is about 25%. Now, Joe's not going to pay cash for the whole property, but this is, again, it's a white formula. It's going to update automatically based on the information that's put in here. If you want to change that, you're welcome to. The loan amount here, he's going to take out 2 different loans. He's going to get an $80,000 loan for 30 years, and it's going to be fixed at 6.9%. He's going to calculate his payment out to $527 every month. His second loan, he's going to have a second on it for $15,000. It's only going to be a 15-year mortgage, and his interest rate is going to be 7.5%. So that's going to calculate his payment there. Notice that, at least on this page, we're not able to do an interest-only loan. It has to be a regularly amortized loan in this section in order for this to work. Okay. Depreciation information. This may be new to some of you, and to others it may be old news. So we're going to estimate that the land value is worth $20,000. At least that's what we're going to use as our basis for depreciating the property. So we're going to say that the improvements or the condo is worth about $115,000, and the rest of the value is in the land. We can't depreciate land. We can only depreciate the improvements that are on it. Now, some of these numbers are arbitrary, as many accounting principles are. So it doesn't have to be exact, but you should put in what you're actually going to use if you purchase the property. This is a residential property, so we're going to use 27.5 years. Now, for potential return information, again, this is skeptical information. So try to be a skeptic here, but also try to be as accurate as you can. Joe knows that in this area, the average annual appreciation rate for real estate is about 3.5%. He knows that when he sells the property, he's going to have to pay a realtor about 7%. And his capital gains tax rate is 15%, and he expects it to stay there over the next 5, 10, or 15 years. Okay, that's all we need for this section. Let's move on to the profit and loss statement. Okay, let's move on to the income statement, or the profit and loss statement. Okay, so here we've got lots of blue sections, and we've got a few white sections down here. Okay, so we're going to start off with the rental income. Joe's going to be able to charge $1,300 a month. All these numbers are annualized, so if you only know the monthly, just do a quick formula, multiply it by 12. That'll get you your annual amount. Right. He's not going to have any late fees. He's not going to have any CAM charges. CAM is common area maintenance. No other revenues either. Strictly rental income. That's going to put his gross schedule income at $15,600 a year. We're going to subtract any vacancies that we have. So Joe is pretty good about renting out his properties, but he is expecting to have about 2 to 3 weeks vacancy every year, or about half a month. So we're going to take this, we're going to divide that by 24, and that's going to give us about half a month's price. Now, Joe also expects in his area to be able to charge rent or to charge more rent over time. Prices usually go up with inflation, so let's put in a 2% increase every year. Now you can see that it's automatically going to update that as we go on. If you don't want it to do that, that's no problem. You just need to go in and zero it out and change it to whatever you want. It will still work without any problems. So let's come down here. That's going to calculate out the gross operating income. So we've taken the total income, the gross schedule income, less any vacancy, equals $14,950. Realistically, that's what he should have coming in every year from this property before any expenses. So now let's move on to the expenses and let's get those in. Advertising, he's probably going to spend about $120 a year. Maybe not every year, but that's probably a good estimate. Insurance, it's a condo, so it's not real expensive, but probably about $200. Doesn't have any of these fees. Property taxes he will have. He's going to be about $12.50 this year, and then it will increase, and so we'll adjust this here up to 3%. This is going to impact all of the expenses down here. Again, it goes up with inflation. We're being somewhat conservative. A lot of times rent will go up by the same percentage, but we're going to be a little bit conservative here in this estimate here. Repair costs. These are basically maintenance costs. So the tenant moves out and Joe needs to put in new carpet. That's the type of repair cost that goes here. He's got about $900 that he's expecting to spend this year, and then a little bit more after that every year. He doesn't have to pay for any of these. Utilities will either be included in the association or the tenant will pay them, but he does have the association fees, which are going to be $195 a month or $2,340 every year, or at least for the first year, and then he should go up. No PMI, nothing other. Value-adding repairs, let me mention this. These are different from repair costs because they are not maintenance issues. These are upgrades that will increase the value of the home that are going to, basically they're going to impact your cost basis for calculating your capital gains tax. So he's not expecting to do any major upgrades, but just to give you an example, adding something like a deck to the backyard, that's going to add some intrinsic value to the home. That would be added down here in value adding repairs. And that's it. That's all we have to do on this one. It's automatically calculated it out every year for us with a 3% increase. We've got total operating expenses here. Net operating income, how do we get there? Well, that's simple. We take the gross operating income, subtract the total operating expenses, and that's our net operating income. From that, we're going to subtract the interest expense. So basically, the interest expense is tax deductible. The interest you pay on the property, you should be able to write off with taxes. You can see that this number is going to go down every year. The loans are regularly amortized, and so they will. The amount of interest paid will decrease every year, and the amount of principal paid will increase as time goes on. Depreciation expense, we can also subtract that before calculating taxes. And then we get to our income before taxes. It's a negative number, and so our taxes are going to be 0. I do want to mention one thing. You may be able to write off some other taxes by using this number. So if your tax rate is 25%, you'd be looking at not quite $200 that you may be able to write off in your taxes somewhere else. This spreadsheet does not take that into account. If you wanted to adjust the formula, you could change that. The spreadsheet here just takes into account that the property is unique to itself and you're not going to subtract anything else from it. So that is the income statement. Gets us to our net income amount of $753 for the first year. You can see after about 4 years, we're in the black as far as net income goes, and then it only increases from there. So that's good. Now, should we be concerned about these numbers? Maybe. Let's go to the balance sheet. So this is pretty basic. We've got current assets, fixed assets, liabilities, owner's equity. Now, if you're new to looking at balance sheets and income statements and statements of cash flow, let me mention a few things that you might look at and say, well, that's odd. Now, the first thing is cash. Well, we'll get to this in a second, but remember we looked at net income and that was negative $753. Yet on the balance sheet, we're showing over $2,000 in cash at the end of the first year. We will get to how that works when we get to the cash flow statement. Just hang on with me for 1 second. We've got the property and the land. We've split those up, and there is a reason for that. And then we've also got the accumulated depreciation. Now, I've had a few people say, well, this doesn't make sense. This number is going down over time. Well, that's right. This is how it should be calculated on the balance sheet. The balance sheet accounts for what you paid for and not necessarily what it's worth. So yes, the value of the property could in fact be moving in the opposite direction, but this is your cost basis on the property. And we'll get to that in a little bit when we go over depreciation. The total assets here is just current assets and fixed assets. The liabilities, we're just going to throw the mortgages into one lump. So it's just the mortgage balance. If you wanted to pay it off after 5 years, that's what you'd be looking at paying. Here's the total. This is going to count for both mortgages if there are two. If there's only one, it'll count for just the one, but if they're both in there, they will both be accounted for in that number. Owner's equity. So we've got owner capital and net income. So the net income, you see, it does show up here on the balance sheet, but it's down in the owner equity section. We can see the owner capital. This is what Joe originally put in, his original investment of $42,500. Now you can see this is updated. This at year 2, the owner capital is just what the total was at the end of the previous year. The way that it works is net income is going to impact owner equity, but it's going to be closed out every year and just totaled into owner's equity. And so that's why there's not a rolling tally of net income. You can see that over time, the owner equity is going to go up and it's going to be higher. Does that really matter? Maybe, maybe not. Here's your total owner's equity, and you always want to double check. Total liabilities and owner's equity should always equal total assets. Okay? And they will. And so if they don't, there's something odd about the way you've put in your information, or more likely, you've probably changed some formulas. And if you change the formulas, now it could be out of balance. And if it's out of balance, you know you need to make some adjustments. Let's move on to the statement of cash flows. Now, a couple things we'll point out here. At the beginning of the year, we're going to assume there is $0 in the account. We're going to assume there's $0 in the account at the beginning of the year. Now, this may or may not be so, but it's going to more accurately account for income from the property rather than income from the owner. So we're going to assume the owner spent all the cash that he had put into the company that purchased this property into his down payment. So he doesn't have any more. The bank account is 0. Now, we take that and we can start from net income to determine cash. However, there's a couple adjustments that we need to make from that number. For example, depreciation expense. Depreciation expense needs to be added back in because it didn't actually impact the amount of cash. So we'll add that back in to net income, and then we need to subtract the amount of principal paid because that did impact cash, but it did not impact the income statement or the profit and loss statement. So let's go back and look at the profit and loss. We can see that we accounted for the interest expense here. However, there's no principal expense. Why don't we account for principal on the income statement? Well, from an accounting perspective, it's not actually an expense. We're taking an asset and we're using that asset to decrease a liability. So let's go to the balance sheet and we can take a look at this. So we're taking cash and we're using that to decrease this liability. At the beginning of the year, the total loan amount was $95,000. Well, at the end of the year, it's $93,609. Why? What's the difference? The amount of principal paid. So even though it doesn't impact the income statement, it does impact the cash flow statement, and therefore is shown on the statement of cash flows. Now, let's move on to the last two. Cash increase or decrease. This is the total cash increase or decrease for the year. And this number needs to be, you need to pay attention to this number through all the years. This number down here is the total amount of cash at the end of the year. So it's not the net increase. You're not making $14,000 every year after year 6. You're making $2,700. Okay, this is the cumulative amount, and this is the amount for just that year. And that's it. So that explains the cash flow statement. And this is an important statement because even though on the profit and loss, we're showing a loss of $753, in the cash flow statement, we're showing an increase of $2,129. So just because a property shows a loss, it doesn't mean you should necessarily throw out that property because it may still have positive cash flow And that may be more interesting to you than having a net income show positive. In fact, by having your net income below zero, it takes away your tax liability. You don't have to pay anything in taxes for the first 3 years because you're not profitable, even though you do have cash flow and you are making money from this investment. Let's go to the last tab, cash flow evaluation. Now I want to start over here in this section over here, return on sale calculations, and then I've got this section down here that has the cap rate and the gross rent multiplier. I want to go over these first. The cap rate is a simple calculation. You take the net operating income and divide it by the purchase price. That gives you the cap rate. So 7.5% is the cap rate in this situation. Is that a good cap rate? Is that a bad cap rate? It could be both. It could be one or it could be the other. Really, it kind of depends on the area and the piece of property. Again, you can't evaluate an investment property solely on the financial information that you can find on it. You also need to evaluate it based on other things, such as location and quality of the property, quality of the past tenants, and lots of other considerations. But it's not the point of this spreadsheet. The point of the spreadsheet is to calculate the financial statements and ratios. So all else being equal, if you have the opportunity to purchase this property or another similar property, and the only difference between the two is one has a cap rate of 7.5% and the other one has a cap rate of 12%, you should probably go with the one with 12%. The gross rent multiplier is very simple. It's a very basic way to try to determine whether or not an investment property is worth what the seller is asking. So in this case, the property is worth $135,000. We take that and we divide that by the gross rents, and that gets us 8.65. If we know that that's the norm in the area, then he's probably priced the property appropriately. However, if you're given with a choice of determining value based on cap rate and gross rent multiplier, I would definitely use the cap rate because the gross rent multiplier doesn't take into account expenses, and the property could actually be losing money. So it's just a very basic level way to evaluate a property. And the cap rate's a little bit better, and then the financial statements are probably pay more attention to those. And then finally, you'll look at the rates of return, and in this situation, we're going to use the internal rate of return and the net present value formulas here. So let me get back over to this section over here. This section assumes that the investor, in this case Joe, is selling the property after 5, 10, or 15 years. You can see we do have a section that is blue, so we can fill that in. We're just going to do $2,500 again for this example. Now, we've got the potential sales price at $160,000. If we go back to the first sheet, we can see that we put in the annual appreciation rate. Remember, it's really 3.5, and that's what's going to be calculated. This number is just rounded. The sales commission is 7%, and capital gains tax is 15%. All three of these numbers are going to come into play with these calculations over here. So if we take the potential sales price, subtract from that the mortgage balance, sales commissions, and the closing costs, that is going to give us, and any taxes, that's going to give us our proceeds. That's how much money Joe is going to walk away with after he sells the property. Okay, so all of these are pretty straightforward. The mortgage balance, we can get that from the balance sheet. Sales commission, we get that just by multiplying this times the percentage, 7%. Closing costs, we put those in right here. The capital gains taxes, that one is a little bit trickier to calculate, and so I'm going to show you how we did it. Come down here. We're going to take the potential sales price, and we're going to subtract, the IRS is going to allow you to subtract any costs incurred due to the sale of the property. So if we subtract sales commission, that one will count, and closing costs, that will count. That's going to get us to $146,614. Now, as we calculate the capital gains tax, we don't need to worry about the mortgage balance. And really all we have to do is say, okay, well, we paid $135,000 for this property originally when we bought it. And so the difference is about $11,000. So that's what we should pay our capital gains taxes on, right? Wrong. It's partially right, except that we also need to account for depreciation that we've already deducted. So over the first 5 years, Joe has written off depreciation expenses and didn't have to pay income taxes on those portions. However, when he sells the property, he will need to pay a capital gains tax on the difference. So we need to go and get our tax basis, or our cost basis at this point, from the balance sheet. We're going to say after 5 years, this is at $116,136. So we'll take that number and throw that in there. Now, we've got to pay tax on the difference between these two numbers, are $30,478. So we know that the tax rate was 15%. So we're going to take that number, multiply it by 15%, and we get the 4572 if we round up, which is that number. Okay, I hope that makes sense. Okay, now let's look at the net present value and the internal rate of return. So we've got three sections here. We've got a sale after 5 years, sale after 10, and a sale after 15. Okay, so we have the cash flows listed down here. We've got the initial investment, the subsequent cash flows, and then after year 5, you'll notice this number is a higher amount than the total proceeds. This is because it also includes the cash flows for year 5, and then finally the total proceeds that come back after taxes and everything else. So why are we using the internal rate of return and net present value? Well, both of these formulas are going to account better for the time value of money. If you're not familiar with that concept, basically a dollar today is worth more than a dollar tomorrow, because the dollar today can be invested, and tomorrow it will be worth more than a dollar, and the dollar tomorrow will only be worth a dollar. Now, let's notice this section up here. We do have a blue section over here, and it's just the discount rate. So what is the discount rate? The discount rate is the required rate of return for an investor. So let's say Joe, in his investment properties, has consistently been able to get at least 8%. So let's put that in there. That's his typical discount rate, his typical required rate of return. But let's say he's got a couple of concerns with this property, and in his eyes it makes it look riskier. And so to account for that risk, he's going to increase that rate of return up to 10%. Okay, so we're going to put a 10% discount rate over here. And then we can come and look at the internal rate of return, the net present value, and try to determine whether or not it makes sense to do the investment. So let's look at the 5 years first. Here's the cash flows for the first 5 years. Here's the internal rate of return, 10.4%. So let's compare that against the required rate, the 10%. Does it beat it? Yes, it does. I do want to mention one thing about the internal rate of return. It is a weakness that it has. The internal rate of return in the calculation assumes that the cash flows received are then reinvested at the same rate of return, so the 10.4. This may or may not be true. Maybe the cash flows come back and they sit in a bank account earning less than 1%. So this number can be skewed a little bit, and a lot of companies, rather than using the internal rate of return, will use the modified internal rate of return because they can better account for their cost of capital. It doesn't make a whole lot of sense to do that here in this situation, so I'm just using the internal rate of return. You're more than welcome to add the MIRR formula into this section and use that equation if you'd like. The net present value calculation basically says on these cash flows, it doesn't take into account the initial investment. It just says these cash flows, if received in this order, are worth this amount of dollars today. So this amount should be compared to the initial investment. If this amount is more, then it makes sense to do the investment. If it is less, then it doesn't make sense. So we can see we've got the net present value. It is positive. It's $794 more. So it does make sense in this case to do the investment. Assuming we've done all the other research and now we're just making sure the investment meets required rates of returns. In this case it does, and so we would proceed with the investment, or Joe would proceed. If we look at 10 years, the investment actually looks like it gets a little bit better. It moves up to 12% as the internal rate of return. Net present value is up to $7,000. Okay, that looks a lot better than just the $700. And the 15 years, the internal rate of return has gone down slightly. The net present value has gotten better. So why, in this case, if the net present value has gotten better, has the internal rate of return actually dropped a little bit? Well, if we look at the cash flows, we can see they're pretty much, they are identical the first 9 years. Year 10, it's different. We get $90,000 back. And then we still only get about $3,000 for the next 5 years if we keep it, or if Joe keeps it. And then after 15 years, gets $132,000 back. So because we mentioned that the internal, or rather a dollar today is worth more than a dollar tomorrow, this formula takes into account all of that. So apparently, this, as far as the internal rate of return is concerned, receiving the $90,000 after 10 years is better than receiving the $132,000 after 15 years. Now, it's not much better, and it's very arguable about whether or not holding it for 10 years or 15 would be better, but theoretically, that's how it makes sense. So when comparing internal rates of return, you just look at which one is higher. When comparing the net present value, this one is determined greatly by the discount rate. So it only shows you how much better the investment would be based on receiving that the required rate of return. So in other words, if the property didn't have the extra risk and Joe went back down to 8%, you can see that all these numbers here will change. So in other words, this $4,585 is $4,585,000 better than simply getting an 8% return on your investment. If we put 0 in here, you can see the investment makes sense no matter what. If your only alternatives are leaving your money in a mattress, then absolutely this investment makes sense. But these calculations are intended to be used in comparing one investment against another to determine which one makes the most sense. So if you have two investment properties or are thinking about investing in real estate versus the stock market, then the net present value and the internal rate of returns work very well.